Welcome back to another Random Gleanings. He is Chris. I am Jesse. And Chris, today we're about a month out from tax day. And that's the appropriate idea. And so...
Jesse, people don't like paying taxes.
People don't like paying taxes. That is for sure. So we thought we'd talk about a tax-smart investing strategy applied to dollars that are not in IRA, 401k type setups. Right.
Non-IRA money.
That's right.
So called direct indexing, custom indexing. And the idea is that, we normally through time have probably, when we had after-tax money, meaning money that we're not putting in the 401k or an IRA or whatever, we just put money in an investment account, right?
Mm-hmm. You've satisfied the emergency account at the bank. You've got all that foundation built, and you've still got dollars to invest.
Yeah,
right?
And so you invest them, right? And you buy an index fund or you buy an ETF or whatever. All right, so as we amass wealth over time, obviously at some point we'll end up building up some money that is not in an IRA, 401k, et cetera. And if we have enough of it, there's a point at which it really starts to make sense to, instead of having a mutual fund or an ETF, where all the stuff is owned in one price, we actually have more of a custom index or a direct index, which is where that index, let's just keep it easy. Like the S&P 100 is 100 companies, right? Mm-hmm. But instead of owning the ETF, we actually own all the individual stocks under the surface.
That's right. And it gives you the optionality for creating some tax benefit that we're going to go into today.
Yeah. So next chart, if you look at the index versus the ETF versus direct indexing, and again, ETF is exchange traded fund, which is just like mutual fund 2.0. Basically, you can't own the underlying securities in the mutual fund or the ETF. They're there, but they're owned by the mutual fund. Mm-hmm. Whereas in a direct index, you own the individual companies.
That's right. Yeah. So, stock A goes up, stock B goes down. You get the average of those two in the index tool itself. But in the direct index, you can sell the loss and keep the gain, or and replace the loss with something different, right?
So, that's more of a tax management or a tax alpha kind of strategy. That's going to give you more benefit or ability to create that, again, tax alpha through the tax loss harvesting side and be able to offset gains elsewhere. Also, it allows you to personalize. Now the difference is, you can go buy a mutual fund or an ETF with not much money. It's normally going to take $250,000 for the custom index. But, the interesting thing is that if you think about an index, any index, the S&P 500, the S&P 400, 600, S&P 100, whatever, not all the stocks go up every year.
Yeah, you get the average of the return of all the stocks, right? And in this next chart, it shows a chart since 2002 where the percentage of stocks that have gone up versus the percentage of stocks that have gone down each and every year.
So a year like 2003, virtually no stocks went down. That was a whole lot of breadth coming out of 3 years of negativity, right? Mm-hmm. But by and large, if you go back during that time period, it's roughly a third of stocks were down every year.
That's right. Something 36-40%, something like that. That's exactly right.
So the idea then is, next chart, let's say that you've built up an asset. It could be a business, it could be real estate, it could be, whatever it is, you build up this gain. Mm-hmm. And then what you're doing ultimately over time, if you own the direct index, is you're beginning to tax harvest those losses from year to year to year. And you have a carry forward. So you can go to Uncle Sam's website and go to irs.gov and read about loss carry forwards on capital gains. They don't expire.
They don't expire. That's
so
the key.
If you were selling a business in the future, if you had whatever
piece of real estate, rental property, whatever it is, and I think you and I have both known people that say, well, I don't really want to own that anymore, but I don't want to deal with
I don't want to pay the gain. That's right.
So
this is a way to begin to both amass some losses for the future, or also begin to work out of holdings that you already have.
And the key here, just so everyone knows, is we're not just investing to get losses, right?
Right.
You get the representative gain or loss of, call it the S&P.
Right.
But within those individual holdings, you've scraped out some of the losers over time, replaced them with a commensurate type of stock,
right.
such that you get that similar like return, but you get to carry those things forward for an express purpose for tax benefit.
Which, by the way, that 1/3 or so loss that's normally in the S&P, that's still there.
That's right.
It's there.
Yeah.
It's just you don't get the benefit of it.
That's right. In the index, ETF, or mutual fund. That's
correct.
Right.
But in this scenario, you do get that benefit. So let's look at an example. Maria's client, Bill, has $1 million portfolio, including $250,000 worth of Microsoft. I wonder who Bill is.
I think the real Bill has a little bit more than
a few
that,
more zeros to be added to this.
Yeah.
But what Maria ultimately does is she uses direct indexing to basically carve out Microsoft, which you can do. You could just restrict and remove from Microsoft from the direct index, and similar technology companies, and allocate those dollars across the rest of the index. Mm-hmm. So you could do that. Absolutely. Another example, this client has a $3 million portfolio, $1 million in her oil company's stock, and that an oil price could impact her job, as well as the portfolio. So ultimately, what can be done in this regard is actually excluding the entire industry from the portfolio.
Yeah, it just separates the risk that her career just entails in a sector of the economy from her investment portfolio. And going back to the Microsoft, there are those that have acquired a great deal of concentration in one position, and it may be I think in the example that we use, they wanted to keep the Microsoft stock, right?
Right. Yeah,
there are those that want to actually kind of work themselves out of
That's correct.
a stock that has a large gain, and you have the opportunity to do that as well. Again, against with using those internal losses against the gains that you have embedded in that big position.
And as the name may imply, it is customizable.
That's right.
Which is good. In fact, next chart, here's an example of the different types of customization that can be achieved in a direct index. Asset allocation, factors like value, quality, size, momentum, dividends, market cap, et cetera. ESG, environmental, social responsibility, corporate governance, that's something that certainly can be blended in as well. Mm-hmm. Again, tax loss harvesting, and position level customization really is all those things we just described with Microsoft and energy. And by the way, they don't all do this individually. I think there are 18 or 19 different providers. Some will do ESG, but not factors. The majority don't do fixed income. This one happens to be one of the tools that we use that fixed income is actually an option as well.
Yeah, I think all of them, just by nature of what they are going to offer some tax benefit or are strategizing to offer some tax benefit there. But not all of them will allow you to create a tax budget. And on this next slide, you'll see that the tool that we use absolutely does allow you to, if you say to the tool, this client has a tolerance to pay $10,000 of capital gains this year.
Right.
It will allow that, but cap it at that level.
Correct.
Right? So.
Correct. And if we happen to get, if the market goes up, there's not going to be necessarily a lot of movement in the portfolio. But if the market goes down, then they'll begin to really take some action that will work to make the most of the situation that they have in front of them, and ultimately try to keep the gain to that 10,000-ish level.
Right. That's right.
It should also be noted that, I've said tax alpha a few times. I asked one of our providers, and you can read about this out there, what the actual, value add has been. They did a 15, 20-year back test, and for large caps, it was like 1.9% worth of realized benefit. Annually.
Right.
Correct.
Yeah.
And it was more than that on mid and small caps.
Now, just like everything in the markets,
it doesn't. It comes in bunches.
That's right. It doesn't come out every single year. So, but that is the annual average over time. And adding almost 2% to a investment portfolio over a long period of time on an annual basis is a meaningful gain.
Yeah, it is. That's definite value add. So, if you find yourself in a position where you've built up taxable money over time and you dislike paying taxes.
Yeah, I think sometimes wealthy people, I've heard it said that they dislike paying taxes more than they like making money.
Yep. So, it's at least equal for sure.
That's right.
So talk to us. Happy to talk about how to do a better job customizing your taxable wealth over time. This is what I believe. I think we believe more and more you'll see deployed with non-IRA money in the future. So just wanted to talk about it.
But not everybody has it available. And so if it's of interest to you and you need somebody that can facilitate it, we've got the answer.
Yep, absolutely. All right, I'm fired up. Found some new shows to watch.
Okay.
I was on the airplane last week for a bit. Couple new shows. Actually, they're not that new, and you may have seen them. One was The Recruit, which is on Netflix.
Okay.
Really entertaining.
Recruit in sport or
no? He's
like
recruited he's recruited in the CIA,
Okay.
and he's fresh out of law school. But the first episode's pretty entertaining.
Okay.
It's good. Also watched the first episode of Mr. and Mrs. Smith. I think that's on Prime, on Amazon Prime. Super good.
I've heard that.
Super good.
I've not tuned in yet.
I mean, it started out and then all of a sudden, it got good real quick.
Yeah.
So definitely worth checking out.
Tune into. Okay.
That's right.
Very
and then Kate Winslet's new show on, I think it's called The Regime on HBO was, or Max rather, was that first episode was good too.
Okay.
I mean, what else? I mean, there was no Jack. Leonardo wasn't around, but Kate Winslet was super good. So
that's good.
Yep.
Yeah, we did a family movie this weekend and watched Mark Wahlberg's The Family Plan, or I think that's what it's called, The Family Plan on Apple. And it's entertaining for sure. The language is a little bit spicy for my kids, but but we just repeated that they should not say those words. So,
understood.
But it was fun.
Good stuff.
Yeah, that's it, folks. Hopefully you've learned something today that's of benefit to you and maybe a benefit to a neighbor or friend or family member. Pass it along, share it, subscribe to our YouTube channel, and we look forward to sharing something new again next week. Take care.
Thanks.